Good evening. Welcome to the DIY bookkeeping series. This is episode 7. What are the different entities? As a reminder, please enable StreamYard. Click on the 3 dots on the video. Enabling StreamYard allows me to be able to see you so that when you are on and when you make a comment, I know who the comment is coming from. If not, it's just going to show unavailable or something like that. So welcome. I thank you for joining me. And again, I always begin with letting people know why I do this. So the reason why we do this live video series is because I realized that because of COVID, as well as other reasons, I'm sure, business owners, some of them for small businesses, may not be able to afford a bookkeeper or CPA. And I don't want you to suffer. I don't want you to fail. I want to set you up for success. And this is for management purposes only. This is not for you to go out and get yourself a new loan. This isn't to go out there and expand your business or anything of the likes. This is specifically so that you know what your business is doing and so that you know how to report the numbers correctly to your tax professional. So let's get started. So today we're talking about what are the different entities. We've had a little break because of Thanksgiving, and I sincerely hope that everyone had an amazing Thanksgiving. I know that a lot of people may not have been able to spend Thanksgiving with their friends and family this year. So it's been a very trying time and definitely a different setting and atmosphere around here. So, but I pray that you had a wonderful Thanksgiving and that there was a lot for you to be thankful for. So let's get started. Let me go on ahead and share my screen. Okay, so we always do a little refresher first. So let's go through the refresher. 2 weeks ago, we discussed when is it good to hire a CPA. So there are several reasons, more than what I have on here, but for simplistic reasons and for the fact that we have a lot to cover tonight, we're only going to go over this for a minute or two. So when is it good to hire a CPA? When you're feeling overwhelmed. If you're overwhelmed, a bookkeeper or a CPA can help you. You've grown rapidly and you don't know what to do. You've been audited and you don't understand why. This is a good chance for a CPA to take a look at your financials. As a bookkeeper, I can assess, I cannot audit. And finally, if you have investments or your books are too advanced. If your books are too advanced, you need a CPA because the CPAs do everything that's advanced. They do all of the advanced stuff that bookkeepers don't do and that owners shouldn't be doing as well. If you have investments, that's going to be a more advanced item. So just a few little side notes there so that we can recap what we talked about a couple of weeks ago. And it's kind of just in time for tax season. Okay, so on to the meat and potatoes. We're going through this quite quickly this time because, like I said, there's a lot of information to go over. So what is a business entity? A business entity is an organization created by an individual or individuals to conduct business, engage in a trade, or partake in similar activities. And these are various types of business entities, and this is just to name a few. This is not all of them. We'll get into what each thing is here in a little bit. So the main ones are a sole proprietorship, a general partnership, a limited liability corporation. I'm sure you've heard of an LLC before, a corporation, and a nonprofit. So what is a sole proprietorship? A sole proprietorship is an unincorporated business with one owner or jointly owned by a married couple. So some examples, and I would love for people to participate in these because I would love for you to give me some examples that maybe I didn't list on these. So examples of being a sole owner and operator of the business could be that you're a freelancer, you're a consultant, a service professional, such as a hairdresser. Some retail stores, depending on how big they are and if they only have one person at the helm. So a retail store can be multiple different types of entities. It can be a sole proprietorship, it can be an LLC, it can be a corporation. Some of the places are nonprofits. We'll get into all of that here in a little bit. So what are the pros and cons of a sole proprietorship? The pros are that it's easy to start. All you have to do is to pick out a name. A lot of times you'll hear the initials DBA. A DBA is doing business as, and what that means is if you are going to use anything other than your name or the city that you are in, then as the name that is, then you have to file a DBA. So for me, if I was not an LLC, then I would have to file a DBA because my name, my legal name is not Miss Elsie, it's Lisa Culverwell. My nickname, one of my nicknames is Miss Elsie. So I would, under a sole proprietorship, have to file a DBA called Miss Elsie's Bookkeeping. Now, if I were to create a DB, or not even a DBA, a sole proprietorship called Crowley Bookkeeping, because it has the name of the city that you're in, and don't quote me on this because it could be different per state. I do know that for California, if you are using the city name and your business name, you do not have to have a DBA. Same for your legal name. If you wanted to use your legal name, like for myself, if I wanted to use Lisa Culverwell Bookkeeper, I wouldn't need a DBA if I was a sole proprietor. Anyway, some more pros are no corporate formalities or paperwork requirements, such as meeting minutes, bylaws, etc. You can deduct most business losses on your personal tax return. And tax filing is easy. All you have to do is attach a Schedule C, which is a profit and loss from business, to your personal income tax return. So as a sole proprietor, you are filing your business taxes on your personal taxes. They automatically get attached to your personal taxes each year. So you make gross profit, that's income. If you've made a loss, then you get to deduct that from your income. Some cons, you're personally responsible for all of the business's debts and liabilities. If someone wins a lawsuit against your business, they can take your personal assets. No real separation between you and the business, so it's more difficult to get a business loan. And it's harder to build business credit without a registered business entity. So when I say a registered business entity, that would be your DBA. It could be the LLC, a corporation. So next we're going to talk about general partnerships, and there are different types of general partnerships. So a general partnership is an unincorporated business with two or more owners. Husband and wife does not count. That is a sole proprietorship. So we would be talking about business partners, two friends. It could be two brothers. It could be father and son, but it cannot be spouses. There are two kinds of partnerships. There are the general partnerships. They all have partners that actively manage the business and share in profit and losses. And then there are limited partnerships. Now, there are two types of limited partnerships. Limited liability partnerships. I'm sure you have seen LLPs, usually next to a law firm. This shields all partners from personal liability. Could also be a doctor's office. Limited liability, limited partnership, that offers some liability protection for general partners, but not all. And what are the pros and cons of a general partnership? The pros, again, it's easy to start. No corporate formalities or paperwork requirements, just like the sole proprietor. You don't need to absorb all the business losses on your own because the partners divide the profits and the losses. So if you have made, we're going to throw this number out there and it's going to be a high number. Let's say you have profited. So you have a net profit, not gross. Gross is before everything has come out of it, all of your expenses, your sales tax, if you have any, things like that. Your net profit, let's say you've made $1 million in your net profit, but you're in a general partnership. And let's say that there's, we'll make it easy. We'll say that there's two partners, you and someone else. You are taking that profit, that net profit, and you're splitting it up 50-50. It's very simple, but the same with all of the expenses. So any expenses that you have paid out, you get half, the partner gets half in order to deduct from your taxes. If you actually made a loss, if your net loss was $50,000, then you split that loss, $25,000, so 50-50. It all gets split between the partners, and depending on how many partners there are, because there are some places that have 3, 4, 5, and 6 partners, that all get split up by the amount of people. Another pro is owners can deduct most business losses on their personal tax returns, just like the sole proprietorship. Cons are each owner's personally liable for the business's debts and liabilities. So again, it gets split. In some states, each partner may be personally liable for another partner's negligent actions or behavior. That is a big one. Disputes among partners can unravel the business. I'm sure you've seen and heard that before. Two best friends fought over a girl or something, and they're no longer friends, and they were also business partners. So now what happens? And finally, it's more difficult to get a business loan or land a big client and build business credit without a registered business entity. So again, that DBA, the corporation, whatever. Next is limited liability corporations, or LLCs. So LLCs are registered. It's a registered business with limited liability for all members. So there are two different types of LLCs. Besides what I actually have written down here, there are your limited liability partners. There's where you'll have 2 or more individuals, and then you've got your single member LLC. So obviously your single member LLC is just going to be you. So the two kinds are the general LLC, which is limited liability for all members, and a professional limited liability company. Those are for professionals such as doctors and accountants. And we're going to go through these with everything, pros and cons of an LLC. Pros are owners don't have personal liability for businesses, debts, or liabilities. That's huge. You can choose whether you want your LLC to be taxed as a partnership or as a corporation. And we'll get into that here in just a moment. Not as many corporate formalities compared to an S Corp or a C Corp. And again, we'll get into that in a little bit. Cons are it's more expensive to create an LLC than a sole proprietorship or a partnership. For a sole proprietorship, the only expense that you may have is the DBA, which in some, depending on the state that you're in, will depend on how expensive that is. In California, to get a DBA, not only do you have to pay the fee in order to request it, but you also have to pay, if I remember correctly, it was over $200. Actually, I think it was more than that. I think it was over $300 to place an ad in the newspaper, and that ad has to stay in the newspaper for 6 weeks so that if another business has the same name, they can contest it. Here in Texas, DBA is minuscule. No newspaper ad, nothing. If it's available, and you pay for it, and it's $25 or something like that. The next are corporations, and there are several corporations, and we're going to get into these. So these are incorporated businesses. So everything that we've gone through so far has been unincorporated. Now we're getting into incorporated. We have the C corporation, which is composed of shareholders, directors, and officers. We have an S corporation, which is taxed as a pass-through entity. A professional corporation, just like the professional partnership, the professional liability partnership, limited liability partnership, is for professionals such as doctors and accountants. And a B corporation is a for-profit corporation that's certified for meeting social and environmental standards. So we're going to go through a few of these here. The pros and cons of a C corporation. Pros are owners, also known as shareholders, don't have personal liability for the business's debts and liabilities. Eligible for more tax deductions than any other type of business. Owners pay lower self-employment taxes. And there's the ability to offer stock options, which can help you raise money in the future. Hi, John. I'm so glad that you could make it. Yes, an LLC is a route I believe is important to my business. Like you said, the separation of personal and business assets is fundamental. Yes, it is. And of course, here in Texas, you've got your, we were just looking into it yesterday, day before, where you can actually homesteading our homes so that if you're sued, they can't touch your home. Well, it's the same exact way with an LLC. So with an LLC, if God forbid you get sued for any reason, then they can't touch your personal assets. They can only touch what you have in the LLC. So if you don't have any money, they don't get anything, and they can't take your house if you own anything personally. Okay, so the cons of a C Corp is that it's more expensive to create than sole proprietorships and partnerships. They face, this is a big one, double taxation. The company pays taxes on the corporate tax return, and then the shareholders pay taxes on dividends on their personal returns. So we were just talking about stock options in order to help raise money for the future. Well, those stock options are going to create dividends for the owners, for the shareholders. And so any dividends that come through, not only are they going to have to pay their normal corporate taxes, they're going to have to pay for the money that they also received in dividends. Owners cannot deduct business losses on their personal tax returns. So that could be a big one if you've got a lot of business losses, a lot of expenses that you've had to shell out for the year. You might want to reconsider getting a C Corp. And a lot more formalities such as shareholder meetings, but also board meetings, minutes, and bylaws. And now we're looking at the pros and cons of S corporations. Pros are, again, no personal liability for the shareholders, no corporate taxation, and no double taxation. So that's a really big one. An S Corp is a pass-through entity. So the government taxes it much like a sole proprietorship or a partnership. Cons are, again, much more expensive to create. There are more limits on issuing stock with S Corps versus a C Corp. And you still need to comply with corporate formalities like bylaws and board and shareholder meetings. And finally, pros and cons of B corporations. So the pros, you might have an edge when it comes to hiring talent, and you'll earn a lot of publicity. Because, of course, this is basically one step above a nonprofit, but it's for profit. The cons are getting accepted is hard, and there are no additional tax benefits from being a B Corp as opposed to more traditional corporations like an S Corp or an LLC. And next we've got the nonprofit, and I believe this is the last on our list here. So nonprofits, as I'm sure you are aware of, is a corporation formed primarily to benefit the public interest rather than earn a profit. And I'd like for you to give me an example of a nonprofit, if you would please, other than what I have listed on the screen. Anyone? So nonprofit organizations can include religious organizations, human rights, animal rights, environmental, charities, homeless organizations. You hear about Habitat for Humanities all the time. They're a nonprofit. The list is almost endless for what you can be doing as a nonprofit, as long as you're not making money. As long as the money is not for profit, then you are a nonprofit. So the pros for being a nonprofit is it qualifies under the 501c, and I don't say 501c3 because there are different types. The 501c federal corporate income tax exemption. So most nonprofits are exempt under state and local tax law. It increases the chance of investments to a nonprofit. People are more willing to donate to organizations, reducing their tax liability. And individuals, there's a typo. It's not founds, it's funds. Individual funds are completely separated from the nonprofit, removing, what did I just do? Okay. Let's get you back on here. Okay. Sorry about that. Individual funds are completely separated from the nonprofit, removing the burden in the case of debts, lawsuits, fines, and other legal matters. Yeah, health and pharmaceutical interests. Only if the pharmaceutical interest is not out to try to sell other pharmaceuticals. In other words, only if they are trying to give away a treatment or something. Hi, Melissa. Thank you for joining us. Thank you so much. So pharmaceutical, that's a gray area, can be a gray area. Health, absolutely, because you've got clinics and such inside of areas of the city that are helping to care for people that may not be able to afford their own health care. So absolutely, but pharmaceutical, I think, could be a bit of a gray area. Cons, they need to raise capital from investors and attract talent with competitive wages. That can be a difficult thing because, as we all know, nonprofits, they don't have a whole lot of money to spend on getting talent and paying out high wages and things like that. The public's reluctance to give nonprofits the same leeway as for-profits severely thwart their ability to succeed. Many need large sums of money upfront from well-established families and foundations. If a person acts illegally or unethically, this is a big one, behind the shield of the nonprofit can be harmed. And donors are more willing to give to organizations with legacies that they foresee surviving long term. So if you are a brand new nonprofit and nobody knows about you, chances are you're probably not going to get as many donations for the first 5 years, maybe, because people don't know who you are and they don't know if you're going to survive. So that is the end of our entities. And so we're about ready to ramp things up. I have been taking this tax course for the last 2.5 months. That has just been kicking my butt. And tomorrow is my final. So I am finally out, which means that I can ramp things up starting next week. So starting next week, we will be holding 3 videos a week. So every Tuesday, Wednesday, and Thursday at the same time, 7 p.m. Central. And we're doing this so that we can ensure that February is clear for tax season. It's going to get busy, y'all. So our next DIY series, episode 8, will be on financial milestones. So it was great having you here. I hope that if you do have any questions, please email me, text me, send me a PM, and I will do my best to answer your questions. So this will be on my YouTube channel, and this will also be on Facebook. So please feel free to share and feel free to watch it again if you need any clarification. And again, you can always come to me and I can answer your questions live. So I hope that you have a wonderful end of your week and a wonderful weekend. And I will see you next Tuesday, not Wednesday, next Tuesday, Wednesday, and Thursday, where we'll be discussing financial milestones. Y'all have a great evening.